Good morning, everyone. JR with Secure Metals, bringing another technical update here for both gold and silver. Today is Monday, September 30th, 2013. It is 11:38 a.m. Eastern Standard Time. And of course, before I get to the analysis, I wanted to show you guys a couple articles. Now, I'll also be doing an analysis for both gold and silver, also the Dow Jones, as well as the dollar index. I'll also compare the gold prices against the Dow Jones prices. We'll take a look at the correlation, which we've been following here for quite some time. And of course, I'll go over some of these articles here. I'm not going to read the whole article, but I will have the link below to the articles if you care to take a few minutes and read them in their entirety. So, on the Lunatics at the Fed, Bill Frankenstein warns, as the fantasy dies, gold will soar. Right now, people continue to believe that the same idiots that created all these problems, namely the central bankers, are going to somehow get us out of it with the exact same policies that got us into it. Is the subtle manner in which the outspoken Bill Frankenstein describes the fantasy in which most Americans live under this wide-reaching interview. We've had so much artificial stimulus, and we've misallocated so much capital, he adds, warning that Americans believe in the lunatics at the Fed and that the rest of the Western world is that way as well. His conclusion is clear: as the fantasy dies, then they will understand the need to own gold, and if the Fed tapers and is forced to untaper, more people will see that the Fed is trapped. So again, pretty short article. You'll find the link below. Canadian billionaire, just a couple weeks ago, about 2 weeks ago, he predicts the end of the dollar as the reserve currency, and he warns it's likely to get very ugly. Beginning with how Kissinger and Nixon enabled the US dollar as the de facto reserve currency through oil, Canadian billionaire Ned Goodman explains in his brief but far-reaching clip how it is both inevitable and rapidly approaching that the rest of the world will turn its back on the dollar, with China and Russia, among many others, that we have detailed in the past, agreeing that the non-USD swap terms for energy, the cracks are starting to show. And as Goodman details, in 1930, everyone wanted USD backed by silver, but today, backed by nothing, everyone wants to get rid of them. Buying hard assets is crucial. He has never been more bullish on gold as we head into a period of stagflation or even high inflation. And as Goodman previously commented, the world is totally upside down right now. It is completely crazy. In fact, he adds, I'm keen on anything that's to live with higher inflationary numbers because I can't see the world getting out of the problem that it's in. Good video is about a 7-minute long video. He gives his speech. And he obviously puts his case on why the dollar will no longer be the reserve currency of the world. Now, another article that I have here by PAUL KRUGMAN. This was written early last month. And this is a scary article, and I'll tell you why. Because Bill Krugman, you've heard me mention him before. He's a Nobel Prize-winning economist, and he's a big Keynesian, and he believes that the amount of stimulus that we've put into the system in the last 5 years have not been enough, and he suggests that we should have, his suggestion is that we should have actually tripled the amount of stimulus. So again, these Keynesians that are running this show, there's no telling what these guys will come up with next. But I'll go over this here. I'm not going to read the full article here, but again, you can click on the link below and you'll find in a few days we'll reach the 5th anniversary of the fall of Lehman Brothers, the moment when a recession, which was bad enough, turned into something much scarier. Suddenly, we were looking at the real possibility of an economic catastrophe, and the catastrophe came. Wait, you say, what catastrophe? Weren't people warning about the second Great Depression, and that didn't happen, did it? Well, yes, they were, and no, it didn't. Now, this is obviously referring to the Great Depression. No, it did not come. No depression came, although the Greeks and Spaniards and others might not agree about the second point. And this is very contradictory to his book, which was written last year, and this depression now. So again, a little bit of a contradiction, and you'll find these Keynesians constantly contradicting themselves. First, he actually wrote a book about, and I actually read a little bit, a little portion of this book. He makes it very clear that this is a depression, not a recession. In this book, he actually makes those points. And let me get to the bottom here, where he actually writes, set aside the politics for a moment and ask what the past 5 years would have looked like if the U.S. government had actually been able to and willing to do what textbook macroeconomics says it should have done, namely make a big enough push for job creation to offset the effects of the financial crunch and the housing bust, postponing fiscal austerity and tax increases until the private sector was ready to take up the slack. I've done a back of the envelope calculation of what such a program would have entailed. It would have been about 3 times as big as the stimulus we actually got, and would have been much more focused on spending rather than tax cuts. So again, interesting article by this guy, and I gotta tell you, imagine this guy running the Fed. This guy would have pumped in 3 times the amount of stimulus. So again, pretty crazy, pretty nuts. And of course, another article here. And now another article here. Fed Dove admits policy causes asset bubbles and they are here to stay. Full speech. I guess you'll find it in the link. San Francisco Fed head John Williams, known for his extremely dovish views on monetary policy and support of record accommodation, appears to have taken some uncomfortable truth serum this morning in a speech reminiscent of previous froth discussions and irrational exuberance admissions. Williams says policy may yield asset bubbles, unintended results. Ooh, that's a bad admission there. Asset price bubbles and crashes are here to stay, and price bubbles are a consequence of human nature. Again, you can read the link, but the guy, again, another Keynesian who just believes that these bubbles are natural and pretty crazy stuff when you take a look at what these Keynesians sometimes what comes out of their mouth anyway. And the last thing here that I wanted to show you, I thought was pretty, it really has nothing to do with gold and silver, but I wanted to show this because, again, this tells you really the direction that this government is going. A book used by schools, Change Meaning of the Second Amendment. Again, just a quick article. You'll find the link below. Obviously, we all know what the Second Amendment is. The Second Amendment is a well-regulated militia being necessary to the security of the free state. The right of the people to keep and bear arms shall not be infringed. And I found it very sad that this textbook actually changed the Second Amendment to the people have the right to keep and bear arms in a state militia. So again, just giving everyone a heads up of of what's going on here in our school systems, or should I say our government school systems, right? And of course, we have today the debt ceiling, government shutdown, Obamacare. Of course, political tensions are continuing to grow, and of course, you have the Federal Reserve printing money like it's like there's no tomorrow. But according to Krugman, not nearly enough money. And here are your charts. And again, I put those articles up there because it really shows you the type of people that we have running this mess. I mean, really, there's nothing positive coming out of this administration. Obama is really a job killer, and I think you're seeing it on the numbers. If you've noticed, we're creating part-time jobs, we're losing full-time jobs, and really that's just all a result of this Obamacare coming and being implemented. But On to the analysis here. Here is your gold chart again. I'll do a few charts today. Here is your gold chart. This is your daily chart here. Currently trading in at 1331. Stochastics are fairly neutral. Really no direction. If I'm looking at this picture here, again, I guess we're kind of forming a little bit of a triangle here where this line comes here, and of course you have this line. So this looks like a triangle here on this side. So we would have to see if this is going to continue to go up higher, or if this is going to test this bottom of this line here and continue to go lower and possibly test the 1270 area. But again, this area is very key, and as we can see here from the charts, the pattern that we've been seeing here, let's say right here, where you have a high, you have a low, you have a higher low, and you have a bit of a higher low right here. We don't want to go below this low, okay? I don't want to see us go below this low here, because obviously if we do, now we have to stay above this low, and that'll be around 1272. So again, usually when you have a triangle, you usually have a move to the upside or a move to the downside, and usually the moves, you do have to watch out for fake outs, but usually you'll have one of these break and it'll go much higher, or you'll have this one break down here and it'll go much lower. And of course this is your low, your high, your higher high, and as of now we're trying to create another high, seeing if we can come up here somewhere, test this 200-day moving average. But as of now, you can kind of say that this is a false breakup to the top. It was a false breakout, and then it just moved. And every time you have a false breakout, you usually have a fast move to the opposite direction. So this you can kind of say that this was a false breakout to the upside, made a quick move to the downside, and you can kind of also say that this was a false breakdown to the bottom. And we're going to see if we're going to move higher, or if this was not a false breakdown and this is just going to continue to go lower. Of course, this number right here, roughly 1277, between 1260 and 1277, very, very, very important levels that we do not want to fall below. That's on the weekly chart. Again, neutral on the stochastics. If we look at the weekly chart here, again, neutral weekly chart as well. We had a move over the 20-day moving average, currently testing the 20-day moving average again, fell below it, and now attempting to move above it again. I believe if we can move above it and we can go over 1350, which was our recent high, then we can most likely continue to go higher and hopefully test this level here on the 1430, 1450 level. Stochastics are starting to change direction, but again, still pointing to the downside. And again, we would have to just wait and see if this is going to, if this a triangle is going to stay, if we're going to see higher moves or lower moves. So we need to keep a very close eye on that. Let's look at silver now. Silver, let's look at this one here. Silver chart here, basically the same thing. This is your 61% fib retracement. We haven't tested this level here yet at 2084. We are in a bit of a short-term downtrend as of now, and of course we can clearly see that we might be setting up for another triangle. I would of course guess that if gold goes higher, silver will go higher as well. Stochastics are neutral as of now, and we have been testing this line here quite a bit. I believe that another test below 1250 will probably easily bring us down to 2080 to test the 61% fib level. And of course, I mentioned, I believe in my previous chart, that I hate these gaps. I can't stand them. I'll put them on a 4-hour chart just so you can take a better look at it. These this is a little bit of a gap, and these gaps usually tend to get filled, and we could see the case where silver comes down to this level 2080, fills this gap roughly at around 2050, and possibly continue to go higher. Stochastics are on the oversold area, but again fairly neutral, looking for a direction, and I think we're going to find a direction here pretty soon, either to the upside or to the downside. Again, being very, very, very cautious with the failed moves. Okay, you can put the same case here, where again you saw silver move up to the make a quick move to the upside, and now it's trying to figure out if it's going to stay at these levels and bounce around or continuing to go higher. Let's look at the weekly chart as well here for silver. That was your daily chart. Let's look at the silver chart. Silver chart looks a little bit better, but I would say that a fall below 2020 will probably bring us down to fill this gap around 2050 easily. And obviously this is a very, very, very key level here for us, 2050. It's key for a number of reasons. It's key because there seemed to be a false breakdown, where again usually false moves tend to give you a quick move to the opposite direction. So again, you can clearly see that a move below this level will probably confirm that this is not a false breakdown here, and it'll probably continue to head lower. A move, if it comes down here to 2050, again, $20 is really the number that I'm looking at. I believe that $20, we don't necessarily want to see $20 or below. As of right now, I like this chart. We are above the 20-day moving average, and I'd like to stay above it and retest this $24, $25, $26 level. Stochastics are starting to curve, but again, still very much to the downside. But the good thing is, unlike the gold chart, is we are above the 20-day moving average on silver. And let's look at this chart here. This is the comparative chart here between the gold and the Dow Jones. Let's take all these things. We're looking at this daily chart here. We can clearly see that throughout the years, gold and silver trade within a positive correlation. You had a big move to the downside. Likewise here in gold, you had a big move to the upside. Gold, Dow Jones did the exact same thing. We had a divergence. So you had a big move to the upside here for gold, move to the downside here for the Dow. We had a positive correlation again, roughly around here, where you had gold move up, the Dow Jones move up here, down and back up, and down and back up here. We traded sideways for quite some time, and of course, roughly around here, we began to see a negative correlation where the Dow Jones continued to rally, and of course, gold continued to head south. And roughly at around here, back in June of 2013, roughly 2 or 3 months ago, we had a positive correlation again, where the Dow Jones moved higher from here to here, and so did gold. And roughly at around here, when the Dow Jones peaked back in late July, gold found some support. The Dow Jones found some resistance. The Dow Jones plummeted. Gold did as well. So we found a positive correlation again. And as of now, it looks like we're trying to find a balance. Maybe the Dow Jones will maybe we'll continue to go higher, or maybe it'll trade sideways for a little bit until gold can either catch up, or maybe Dow Jones will come down and gold will stay around these levels for a little bit before they find a positive correlation again and they continue to both go higher. So again, really, it looks like right here we broke positive correlation again. We started trading to the negative. Again, the Dow Jones went up, gold went down, and over here it looks like gold is trying to move to the upside, and of course the Dow Jones is continuing its short-term trend of a move to the downside. Let's look at the Dow Jones alone. A couple crazy lines that I've drawn here. I'll get these things out of the way. Let's see here. So this is your Dow Jones. It does look like a Dow is trading within this range here. This morning it came down to 1588. Currently trading at 15166. Just a bit under a 15.2. So we might find some support here at around 15,000 even before we continue to go higher. But again, this does look like a giant tunnel here. So we could test this level here at 15K. We can probably test this 23% Fibonacci retracement here just under 15,000, 14,900. Sorry, I meant to put this chart is actually the one I wanted. That was your daily chart here. Now, as of now, stochastics are pointing higher or beginning to point higher, but they are on the oversold side, which suggests we might continue to go down a bit further. But again, we are getting to the oversold side, so we might see a correction back to the upside, either here at 15, either here at 14.9, or roughly here where you see me where I drew this line here, roughly at around 14.828. But again, beginning to be oversold, and we are looking for a change in direction. Below all moving averages as of now, and of course on the weekly chart. Again, this one doesn't look too positive. It does look like we're going to try to at least over here, if you look at the stochastics looks like they're trying to change direction. But as of now, we're still trying to find support at this 20-day moving average, and there's no telling where this is going to go here in the short term. But it does look like we will be trading sideways for some time. So that could be the case, that we might trade sideways for a little bit of time. So this might be where we find resistance and support over here, but really no direction on any of these charts. Let's look at the dollar chart now. Of course, you've heard me mention about this broadening formation. I'll tell you about the broadening formation. It's usually bearish in nature, and you usually don't find many broadening formations. And I'll tell you that the market is such in such a disbalance that we are seeing them a lot. And again, not one of my favorite technical formations, but nonetheless it's still one of the formations out there that we want to pay attention to. And over here we have the broadening formation that the Dow Jones has provided for us. I think it will look more like that. So again, you've heard a couple people suggest that the Dow Jones will see 6,000 in the next few years. You know, there are a lot of indicators, the gold and the Dow ratios, that suggest that. Also, this broadening formation that also suggests that. If you look at the monthly chart is oversold. It has been oversold for quite some time. It has been finding some support here on the stochastics over here. So eventually this will give out and this will break, and you're gonna have a big move to the downside. I mean, I gotta tell you, you have to be very careful with this market, because again, the stimulus is causing a lot of imbalance, is causing a lot of distortion, and you can tell that right now the market is really, I mean, when it's not that, like I said before, when it's not the debt ceiling, or it's the government shutdown, if it's not Obamacare, is the Federal Reserve printing money, and if it's not the war in Syria, is the war in Afghanistan, if it's not that one, it's another one, and it's this again, this is distortion at its finest. And you know, this is exactly why we need to be very, very, very well diversified. I'll show you another broadening formation. I think I've shown you guys a few broadening formations. Look at this chart. This is a beautiful broadening formation here, where you have a high, you have a high, a higher high, a higher high. And then of course we're looking at the low, a low, and then we'd look for another low roughly around this area 143 from 167. That's a big move to the downside, I'll tell you. So But again, I like this right here, shorting right here. This is a good time to short the crap out of this. I would look to take profits. And this is the British pound versus the US dollar. I would look to take some profits, roughly around 57 to 55. That would be the middle. That's a safe call, even if it doesn't come down all the way down. Of course, you saw it on the Dow Jones. I'll show it to you right now on the dollar as well. This is the gold chart. Let's bring up the dollar. This is your dollar chart. We've also studied this broadening formation as well, which I think some might argue that this formation has been completed. So we'll have to see if that's the case. We don't normally always test these lines. As you can see, sometimes it goes over the lines. But these broadening formations just suggest higher highs and lower lows. And of course, this was the previous low back in June. And now we're seeing a lower low. And like I said before, that we were going to test the 80. I think I discovered this line roughly around here. And I made a prediction that we were going to test the $80 level. And as of now, the lowest we've seen this price was this morning. So as you can see, this morning we came just below just above the 80 level. And so again, this formation might have finished, and it can possibly just trade around this level here. Usually these bearish formations usually end with the market trading at these lower levels here for a little bit of time before they head higher. But again, one can say that the move has been complete, and we have created a lower low. You have a low, 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 and then of course another low. I don't suspect this market to come back up here big, unless this is a false breakdown to the downside. Then of course you'll see a rapid move, and of course you have a gap here. I don't like gaps, so you might see this gap filled at around 81 here pretty soon. If we look at the weekly chart looking a bit oversold here at this level. We might test this 79 level here, because it seems like this is a good support level here. Let's draw a horizontal line right here. So again, we might see this come down to the 79 level before it decides if it's going to come back up here and then continue to go further down, or if this is just going to find some support here between the 79 and the 80 zone, and then fill this gap and come up here somewhere. So let's look at the long-term time frame here for the dollar. And this will be your final chart. We can clearly see that we are in a bear trend here on this chart. And always remember, the trend is your friend. And I'm going to do another line here which suggests that the dollar is in a triangle. And we'll be looking to see where this goes, if it's going to go back up here to 86 and test this level, this line here, or if it's going to break this line that we see here and test this bottom side here on 75. But on the monthly chart, which is again an extremely slow time frame, this can potentially come together within the next year or so. Again, this is a monthly chart. So if we look at the weekly chart, stochastics are getting to the oversold side, so we could look to see a little bit of a move to the upside. But as of now, really, guys, the market is really just not in a position where you want to. It's not in a position where you want to make any big sudden moves to either direction. There's a lot of choppy trading here lately, and at this point, all we know is the facts. The government has no idea what they're doing. They can't even pass bills. They can't even, I'd like some comments. Anyone can tell me what this government is doing right. I have no idea. But again, having your money in dollars in this day and age is just really dangerous. And you can clearly see with this trend line here with gold that gold is in a beautiful upward trend, and you want to stick with your friend, and the trend is your friend. You had a big move to the downside here from here, and never touched the 60% Fibonacci, the 61% Fib level. 1290 might be another great time if it does come down here. Might be a good time to pick up some at these levels, but of course the next level I would pick up would probably be around 1148 on my long-term positions, if we even see those numbers. As of now, we are testing this 20-day moving average, and this will give us a little bit more of a direction within the next coming days. All right, guys, I hope you enjoyed the video, and thanks for joining me. Bye-bye.